Welcome to The Explainer. Today, we are diving into something that sounds, well, maybe a little dry: international accounting. But stick with me because it's actually this incredible story. It's about competing philosophies, secret languages, and this huge global quest to get everyone on the same page. And to kick things off, I've got a little puzzle for you, one that really gets to the heart of what we're talking about.
So think about this for a second. How is it possible for one multinational company with the exact same financial data, to report a big, healthy profit in one country, but then turn around and report a loss in another? I mean, that sounds completely impossible, doesn't it? But it's not. It happens. And the answer shows us something really fundamental. Accounting isn't just math. It's all about the language that those numbers are speaking.
Okay, so here's the big idea you need to hold on to. Accounting, it's not like math, which is the same everywhere you go. It's much more like a language. And you know how languages have different dialects? That's exactly what's going on here. These different dialects of accounting have popped up all over the world, and each one is shaped by its own unique environment. So, what do we even mean by an accounting system? Well, you can think of it as the whole rule book, the entire framework a company uses to report its financial story. But here's the key: it is not just a bunch of dry, abstract rules. No way. It's completely tangled up with a country's laws, its economy, and yeah, even its cultural values. And that right there is the whole point. Because every single country has its own unique mix of those things: laws, culture, economy. No two national accounting systems are identical. They're all kind of like custom-built machines, designed specifically for the place they operate in. Now, even though every country has its own special flavor, most accounting systems tend to fall into one of two big families. You can think of them as two major philosophical camps. And this creates this huge divide in how the entire world approaches company finances and reporting. Okay, so on one side, you've got the Anglo-American model. Let's call this one the public speaker. This is what you see in places like the US and the UK. Its main job is to talk to a huge audience of public investors. So the goal is total transparency, giving everyone a true and fair view of what's going on inside the company. Then, on the other side, you have the continental model. This one is more like a private conversation. It's common in countries like Germany, France, and Japan. And here, the main audience isn't the public. It's historically been the creditors, the big banks. So the goal isn't transparency, it's creditor protection. That means the accounting is way more conservative, very careful, and all about sticking to the letter of the law. And there's this fantastic quote from a researcher, C. Nobes, that just nails why we have these two different worlds. He says, "The financing system determines the purpose of financial reporting." It's so simple, but so powerful. Basically, whoever gives you the money decides what the financial reports need to say. If your money comes from thousands of regular people buying stock, you better be transparent. But if your money comes from a handful of huge, powerful banks, you just need to prove you're a safe bet and can pay them back. Okay, so that's the theory. But let's make this way more concrete. Let's see how these two models actually play out in the real world by looking at a tale of two giants: the US, which is our classic Anglo-American example, and Japan, which traditionally follows the continental model. Just look at how they decide to spend huge amounts of money on big projects. US companies almost always use something called discounted cash flow. It's a very complex way to predict future profits and build a model for all the potential risks. Japanese firms, they often use something much simpler: the payback period. They're asking a totally different question: how fast can we get our initial investment back? Risk isn't something they plug into a spreadsheet. It's a judgment call made by experienced managers. So, why the huge difference? Well, Japan's choice isn't just random. It's actually deeply strategic. It makes perfect sense when you think about their business strategy, which is often about winning with technology in really fast-moving industries where products become obsolete quickly. They have to innovate and get their money back fast. And it's not just about big investments. This philosophical split goes all the way to how they decide if a manager is doing a good job. In the US, it's all about the financial numbers. What's your profit? What's your return on investment, or ROI? It's all about how efficiently you're using the company's money. But in Japan, the focus is often more on the long game. It's about what's happening out in the market. Are your sales growing? Are you stealing market share from your competitors?
It's a game of market dominance, not just short-term profit.
And this part is absolutely fascinating to me. The differences go right down to the people who are actually doing the accounting. In the US, an accountant is usually a specialist. They went to college, they got an accounting degree, that's their career. But in Japan, a cost accountant might be a generalist who didn't even study accounting. They've probably spent 10 or 15 years rotating through all sorts of jobs in the company: sales, production, you name it. They're not just numbers people, they're business people first, and that completely changes how they look at the data.
So you can probably imagine with all these different dialects floating around, it gets pretty confusing and expensive for companies that operate all over the world. So it's no surprise that for decades there's been this big push, this quest to create one single unified set of rules, a true global language for accounting.
And man, this has been a long road, as you can see here. It really kicks off way back in 1973, when the first International Standards Committee was formed. Then a really big moment happens in 1998. Germany, a huge player in that continental model, says, okay, our companies can now use international standards. But the real tidal wave hits in 2005. That's when the entire European Union makes these new rules, called IFRS, mandatory for all their big, publicly listed companies. Things got so serious that even the US started putting together a roadmap to maybe make the switch themselves.
And the whole goal behind all this work, this decades-long project, is actually pretty simple. 1, make life cheaper and easier for global companies. And 2, make it so an investor can actually compare a company in Berlin with a company in Boston, apples to apples. The hope was to create a truly efficient global market for capital. So, mission accomplished, right? We have this new global language, IFRS, so everything's uniform now. Well, not quite. It turns out, even when everyone's reading from the same rule book, those deep, historical, national differences, they don't just disappear. They kind of stick around, like a local accent in how this new global language gets spoken. So why do these accents stick around? Well, there are a few big reasons. First, the IFRS rules themselves aren't super rigid. They're principle-based, which means there's room for judgment. And guess what influences judgment? Local habits. Second, you've got national tax laws. In a lot of countries, the rules for paying taxes and the rules for financial reporting are tied at the hip, and that's a really hard link to break. Third, that fundamental split between the legal systems we talked about, that's still there. And finally, you just can't ignore culture. Those deep-seated values about secrecy versus transparency, they are stubborn, and they still absolutely shape how the rules get used in the real world. So here's really the bottom line. This push for one standard has been a huge, huge step forward. But you can't just parachute a single set of rules onto all these wildly different countries with their own laws, cultures, and economies and just expect everything to look exactly the same. The local context, the accent, still matters a lot. And that leaves us with a really big question to chew on. Is a single, perfect, uniform global language for business even a realistic goal? Or, given just how deep these differences run in how we all do business around the world, will we always, on some level, just be translating?